Hi everyone, welcome back to the channel. In this video, I'm going to reveal my full dividend growth investment strategy. I'll talk about the ideas and the logic behind choosing my method and what I feel are the main benefits and drawbacks of investing this way. I'll also mention how I pick my stocks and whether ETFs and index funds have a place in my portfolio. But first of all, I'm going to discuss the two ways that investors can build wealth by investing in stocks. They'll either look for capital growth, where that stock that you bought for $20 is now worth $50, so you'd sell the share and pocket the $30 profit. Or you'll look to buy shares that pay a dividend. Hold on to that share for the long term and then pocket the dividend payments that come your way. My strategy is based around the theory behind the second method, where I look to buy and hold dividend-paying stocks while reinvesting all dividends back into the portfolio. I'd also hope that the company I hold shares in will increase their dividend payouts over time. This can be very beneficial for the dividend yield of the portfolio. For example, if I bought a share for $20 that paid a dividend of $1, I'd have a 5% yield. If that dividend was then increased over time to $1.50, my yield on cost would be 7.5%. By targeting companies that increase their dividends over time, I hope to be able to grow an attractive yield on cost over the long term. I don't want to ever sell any of my stocks, for the simple reason that I'll lose out on any future gains if I no longer hold the share. Using my previous example, that $20 share may have grown to $50, but what if it continues to grow to $150 afterwards? I won't get any extra benefit as I no longer own the share. My plan is simple: buy dividend growth stocks and hold on to them. I view my portfolio as an income-generating machine, and I don't worry about the market value of the portfolio, but instead just focus on the value of the dividends that get paid to me each year. Over the last 40 years, 71% of market returns came from dividends. When I receive a dividend, I'm instantly realizing a gain, as that profit is locked in. No one can take that away. With market value fluctuations, you can be up one day and down the next day, and unless you sell when you're up, you don't actually realize any gain. So why have I chosen this route? There are three main reasons why I've chosen a dividend growth investing strategy over value investing for capital growth, which I'll go over now. The first reason is cash flow. Dividends provide me with a source of passive cash flow. By simply holding stocks in dividend-paying companies, they'll pay me either monthly, quarterly, biannually, or annually. I'm a qualified accountant by trade, and there's a finance saying that cash is king, which is a premise that a strong cash flow allows a company or an individual more flexibility in regards to business decisions and potential investments. By creating a cash flow for myself, this will allow me to initially reinvest all dividends into purchasing new shares, and eventually, I hope that the cash flow created from dividends can help towards pay my expenses in the far distant future. The second reason is the compounding effect of reinvesting dividends back into my portfolio by using the dividends to buy more shares. Reinvesting dividends is one of the most effective and reliable strategies available for increasing stock portfolio returns over time. I don't intend to ever take cash out of my portfolio, instead choosing to reinvest all dividends back into my portfolio. The premise behind dividend reinvestment is that after a company pays you a dividend, you use it to purchase more shares in your portfolio that pay more dividends. Then you use that dividend to purchase even more shares that pay even more dividends, and so on and so on. As this process is repeated over time, a modest initial sum can eventually become much more substantial as the snowball effect of compounding takes hold. I did a full video on this where I discuss this in more detail and show full real-world examples of how following this method can really boost a stock portfolio. Please check this out if you're interested. The third reason I've chosen dividend growth investing over investing for capital growth is that I don't have to worry about the overall price of my portfolio. As I won't be selling my stocks to provide an income, I actually like it when my portfolio is showing a loss, as it means the stocks I have are on sale for a cheaper price than I paid previously. I basically get to purchase future income at a discounted price. Don't get me wrong, I do occasionally monitor the value of my portfolio, but it's fairly irrelevant to me and my goals, and I don't overthink it. I'm in this for the long term. I see every stock purchase as adding another component to my dividend-producing machine. Whether the market is high or low, each share I obtain will increase the expected future dividend total. I'm all about keeping my investments simple and stress-free, so being able to have this mindset is important to my overall mental well-being. The last thing I want to do is to be manically checking the market value of stocks all day. So how will I pick my stocks for my portfolio? I've built my investment portfolio by looking for mature, stable companies with a track record of paying reliable and growing dividends year on year. By choosing these types of blue-chip companies, they should continue to pay me consistent and dependable dividends for as long as I hold the stock. There's no rocket science or complex algorithms for me when it comes to picking a stock. It all comes down to them having a history of reliable dividends and being a business that I think can continue to make profits for decades to come. With that in mind, 36% of my stocks in my portfolio are still either classified as dividend aristocrats or dividend kings. These are companies that have increased their dividends for at least 25 years for an aristocrat and 50 years for a dividend king. Another 34% of my portfolio have increased their dividends over the last 10 years at least, so will hopefully be on their way to becoming a dividend king or a dividend aristocrat. Even in today's climate, that's 71% of my portfolio that still have a stable dividend history, which I have to be pleased with given all of the dividend cuts over 2020. My portfolio may be down in terms of market value, obviously if I was to sell everything, but it's pleasing to see that I'm still receiving a solid amount in dividends. So, for balance, what can go wrong? The number one issue I could face is companies that suspend or cut their dividends. It's important to remember that dividends aren't guaranteed. This is a possibility with any company, but dividend cuts aren't always bad news in the long run. For example, some companies will cut their dividends to instead invest the cash into revenue-increasing projects. This can help in the long term as it could make the company more profitable, and therefore would likely improve future dividend payments. Short-term pain for long-term gain. It's also very unlikely that a reliable dividend-paying company would just suddenly stop paying dividends altogether. Markets react badly to dividend cuts because investors and analysts start to fear the worst, especially if the company's rivals are maintaining their dividend payments. The company may then have difficulty raising additional funds because investors and lenders will naturally shy away from companies perceived to be in financial trouble. For this reason, most companies will do everything in their power to defend their dividend payouts. So you might also be asking, why don't you just invest in index funds? Which would be a very good question. I do have index funds in my portfolio and they do offer some great benefits. I want to further protect my dividend payments, so I do intend to eventually have around 40% of my portfolio in index funds in the long term. The reason I do choose individual stocks as well as index funds is that I enjoy the greater control over what constitutes my portfolio. With individual stocks, I can make sure that I invest in businesses that I understand, whereas with index funds, I've got no say in the composition of what makes up the fund, which are usually made up of dozens and dozens of companies. With individual stocks, I can research the business fundamentals, the investor reports, and the dividend history of the company very easily. It would be difficult to monitor index funds in the same way. Therefore, if I only had index funds, the performance of my investment portfolio would depend on circumstances beyond my control. Also, if you compare the history of dividends from an ETF and the history of dividends from a stable dividend-paying company, you'll see that the dividends from the individual company are usually more reliable and predictable. ETF dividends tend to fluctuate quite a bit as the dividends are from a huge, diverse range of companies. It's important for me that I receive a dependable cash flow in order for me to effectively reinvest dividends and let the magic of compounding take hold. I do like the way that index funds offer greater safety numbers, as if you only invest in a few stocks and one of those companies cut their dividend, having all of my eggs in one basket could hit me quite hard. Whereas if one company out of hundreds cut their dividend in an ETF, the effect wouldn't be as noticeable. There are a lot of interesting and logical arguments for both sides, which is why, over time, as I say, I intend to have ETFs make up around 40% of my portfolio, just to give me greater protection against dividend cuts. There's absolutely nothing wrong with just choosing ETFs. If you're someone that wants to start investing without reading a myriad of financial data and investor reports, then ETFs are perfect. So to conclude the video, this is my personal strategy, and I'm sure some people will agree with me and some will disagree with me. Some might not have an opinion yet, but just wanted to take an open-minded look at someone else's strategy. As I say, I'm in this for the long term, and this strategy may evolve and change over the years. If it does, then I'll be sure to update you. I want this channel to document my investment journey, and I hope that by watching my videos, you'll learn from any of my failures and hopefully my successes too. This isn't investment advice, and obviously you should always do your own research, but I hope that my videos are thought-provoking and provide a source of inspiration and ideas for your own investing journey. If you have enjoyed the video, then please press that like button and subscribe to the channel. I'd also be really keen to interact with as many of you as possible in the comments section below. Thanks again for watching, and I'll see you on the next video.